Hey there, fellow investors. Iggy here from the Investing Iguana. Today, we're diving into a hot topic that could seriously impact your portfolio of 5 Singapore REITs with strong sponsors and gearing levels below 40%. In this video, I'll break down why these factors matter and how they can help you weather economic storms while potentially boosting your returns. Whether you're a seasoned investor or just starting out, this information is crucial for making smart decisions in the ever-changing world of REITs. So, grab your favorite beverage, get comfy, and let's dive into the world of rock-solid Singapore REITs. Why strong sponsors and low gearing matter. Let's dive deeper into why strong sponsors and low gearing matter when it comes to Singapore REITs. Essentially, strong sponsors provide a safety net for REITs, offering financial backing and a pipeline of quality assets. This means that if a REIT encounters any difficulties, its sponsor can step in to provide support, much like a reliable and wealthy relative who can lend a helping hand. Additionally, a sponsor with a strong track record can also provide a steady supply of high-quality assets, which can enhance the REIT's portfolio and drive growth. On the other hand, low gearing is also crucial, as it indicates that a REIT has a manageable level of debt. When a REIT's gearing ratio is below 40%, it means that it has a healthy balance sheet and isn't over-reliant on debt to finance its activities. This is similar to having a manageable mortgage on your house, where you have a comfortable cushion to absorb any unexpected expenses or financial shocks. In contrast, high gearing can be risky, as it may leave a REIT vulnerable to financial stress and limit its ability to navigate challenging market conditions. By focusing on REITs with strong sponsors and low gearing, investors can increase their confidence in the REIT's ability to generate stable returns and weather any storms. With these factors in mind, let's take a look at our top 5 picks. 1. Mapletree Industrial Trust, MIT. Mapletree Industrial Trust, MIT, is a powerhouse in the real estate investment trust, REITs, space, boasting an impressive portfolio of 160 properties spanning across Singapore, the United States, and Japan. With assets valued at 9 billion Singapore dollars, MIT's clout is undeniable. Its sponsor, Mapletree Investments, manages a staggering 77.5 billion Singapore dollars in properties, further solidifying MIT's reputation as a force to be reckoned with. In terms of recent performance, MIT has demonstrated steady growth, with revenue increasing by 2.7%, net property income rising by 1.3%, and distribution per unit ticking up by 1.2%. Moreover, MIT's gearing stands at 39.1%, just below the 40% threshold, indicating a healthy balance sheet. The trust has also taken a prudent approach to managing interest rate risk, with 82.1% of its loans fixed, providing a degree of protection against rising interest rates. 2. Parkway Life REITs, P-Life REITs. Parkway Life REITs, P-Life REITs, is the healthcare champion in our midst, and for good reason. With a diverse portfolio of 63 properties, including hospitals in Singapore, nursing homes in Japan, and a specialist clinic in Malaysia, P-Life REITs has established itself as a major player in the healthcare real estate space. Its sponsor, IHH Healthcare Berhad, is a leading hospital operator, further solidifying P-Life REITs' credibility. In terms of recent performance, P-Life REITs has shown some variation, with revenue dipping by 2.7% due to the weak Japanese yen. However, this was offset by a commendable 3.5% increase in distribution per unit, which is certainly a positive sign. Moreover, P-Life REITs boasts an impressive financial position, with a low gearing of 35.3% and an enviable 10.6 times interest coverage ratio. Its cost of debt is a mere 1.35%, with a whopping 90% of its loans on fixed rates, providing a high degree of protection against interest rate fluctuations. This is akin to securing a super cheap mortgage and locking in the rate, ensuring stability and predictability for the trust. As of July 30, 2024, P-Life REIT's stock price closed at 3 Singapore dollars and 63 cents, experiencing a slight uptick of 0.28% for the day. The company has also demonstrated its resilience in the face of currency headwinds, reporting a nearly 4% increase in distribution per unit, DPU, for the first half of 2024. This bodes well for investors seeking a steady and reliable performer in the healthcare real estate sector. 3. CapitaLand Ascendas REITs, CLAR. CapitaLand Ascendas REITs, CLAR, is the ultimate globetrotter in the industrial REIT space, boasting an impressive portfolio of 229 properties spanning across Singapore, the United States, the United Kingdom, Europe, and Australia. With assets valued at 16.9 billion Singapore dollars, Clarke's reach is truly vast. Its sponsor, CapitaLand Investment Limited, manages a staggering 134 billion Singapore dollars in assets, providing a robust backing for Clarke's endeavors. In terms of recent performance, CLAR has shown some remarkable growth, with revenue increasing by 7.2% and net property income rising by 3.9%. However, distribution per unit dipped by 2.5%, primarily due to the issuance of more units. Nevertheless, Clarke's financial position remains solid, with a gearing of 37.8% and a respectable 3.7 times interest coverage. Moreover, the trust has achieved an impressive 13.4% positive rental reversion, which is akin to receiving a substantial raise in rental income. As of July 16, 2024, Clarke's stock price closed at 2 Singapore dollars and 72 cents, remaining steady for the day. In a recent development, Maybank Research upgraded CLAR to a buy rating, setting a price target of 2 Singapore dollars and 90 cents, citing the potential for upside in the industrial sector. This vote of confidence from the research firm suggests that Clarke's prospects are indeed promising, making it an attractive option for investors seeking exposure to the industrial real estate market. 4. Frasers Centrepoint Trust, FCT. Frasers Centrepoint Trust, FCT, is the go-to expert in neighborhood malls, boasting a portfolio of 9 suburban retail malls and 1 office building, with assets valued at 7.1 billion Singapore dollars. Its sponsor, Frasers Properties Limited, manages an impressive 40.1 billion Singapore dollars in assets, providing a robust foundation for FCT's endeavors. When it comes to occupancy, FCT is nearly at full capacity, with an impressive 99.7% retail occupancy rate, indicating a high demand for its properties. Moreover, the trust has reported increasing shopper traffic and tenant sales, further solidifying its position as a leader in the suburban retail space. FCT's financial position is also worth noting, with a gearing of 39.1% and a respectable 3.2 times interest coverage. The trust has taken a prudent approach to managing its debt, with approximately 2/3 of its loans on fixed rates, providing a degree of protection against interest rate fluctuations. Additionally, FCT is actively enhancing its properties, as evident from its ongoing refurbishment of Tampines 1 Mall, which is expected to generate an impressive return on investment of over 8%. This strategic move is akin to renovating a rental property to command higher rent, demonstrating FCT's commitment to maximizing value for its investors. 5. CapitaLand Trust, Class. CapitaLand Trust, Class, is our specialist in the hospitality sector, boasting an impressive portfolio of 102 properties spanning across 45 cities in 16 countries, with assets valued at 8.5 billion Singapore dollars. Its sponsor, CapitaLand Investment Limited, is the same as Clarke's, providing a strong foundation for Class's endeavors. In terms of recent performance, Class has shown some notable growth, with revenue increasing by 11%, indicating a robust demand for its hospitality offerings. However, distribution per stapled security took a bit of a hit, dipping by 8%, which, although not ideal, is still relatively resilient. Class's financial position remains solid, with a gearing of 37.2% and a respectable 3.7 times interest coverage. Moreover, the trust has managed to keep its cost of borrowing remarkably low, at just 3%, which is a significant advantage in the current market. This prudence in managing debt, combined with its diversified portfolio and strong sponsorship, positions Class well to navigate the ups and downs of the hospitality industry. As the trust continues to optimize its properties and capitalize on emerging trends, investors can look forward to potentially benefiting from its expertise in this exciting and ever-evolving sector. Wrapping up. And there you have it, fellow iguanas. We've explored 5 rock-solid Singapore REITs that are built to withstand economic turbulence while potentially padding your portfolio with steady income. Remember, these REITs aren't just about the numbers, they've got quality assets, smart management teams, and strong sponsors backing them up. But before you rush off to hit that buy button, always do your own research and consider how these REITs fit into your overall investment strategy. While REITs can be a great way to add some steady income to your portfolio, they're not without risks. Market conditions, interest rates, and sector-specific challenges can all impact performance. If you found this deep dive into Singapore REITs helpful, don't forget to smash that like button and subscribe to the Investing Iguana channel. We're always cooking up fresh content to help you navigate the wild world of investing. Got questions or want to share your own REITs insights? Drop them in the comments below. I love hearing from you all.